2.1%. That's where global growth lands if the Gulf crisis drags into next year. And the OECD says we're heading straight for it. The OECD just took a machete to its global growth forecast, and the numbers are ugly. In its June economic outlook, the organisation cut its 2026 projection from 3.4% to 2.8%. That's the optimistic scenario. The dark scenario, their words, not mine, paints a picture of 2.1% growth next year and just 1.8% the year after. Those are levels we haven't seen outside of major crises like the pandemic. Now, you're probably thinking, what's driving this? It's the Strait of Hormuz. The US-Iran conflict has choked one of the world's most critical shipping lanes, sending energy prices surging and dragging fertilizer and industrial input costs up with them. When we covered oil climbing 3.9% on Sunday, we said to watch for second-order effects. This is exactly that. Chief economist Stefano Scarpetta warned that without a durable peace settlement reached quickly, some economies tip into outright recession. For your portfolio, this matters because global slowdown reprices everything. Bond yields shift. Multinational earnings get squeezed. If you hold broad international index funds, the OECD just told you the baseline assumptions baked into those valuations are wrong. And here's what makes this worse. The pain isn't staying overseas. Turning to Washington, the trade war just got a sequel nobody asked for. Overnight, the US trade representative announced new tariffs targeting 60 trading partners simultaneously. According to Fortune, allies like Canada, Mexico, the EU, and the UK face a 10% levy. Countries including China, Brazil, and India get hit with 12.5%. The justification? Forced labour in supply chains. Ambassador Jameson Greer called the status quo unacceptable, saying American workers face an unlevel playing field. But here's the twist buried in the details. The White House carved out exemptions for coffee, beef, and microchip suppliers. That tells you something critical. Someone inside the administration knows exactly how high-frequency grocery purchases shape inflation perceptions heading into midterms. They're trying to raise revenue and restrict trade while keeping the checkout line calm. Think about it this way. The tariffs that hurt you are the ones on things you buy every week. The exemptions reveal the administration's pressure points. For your 401k, this is a margin compression story. Companies that import components, raw materials, or finished goods just saw costs jump. Consumer staples and industrials with heavy import exposure are most vulnerable. If you're overweight in small-cap international or emerging market funds, this round of tariffs adds a new layer of risk that wasn't priced in yesterday. But the biggest tremor today isn't coming from governments. It's coming from inside the financial system itself. And on Wall Street, a word that makes portfolio managers lose sleep: redemptions. Partners Group, the Swiss private capital giant, just capped investor withdrawals in its $8.6 billion flagship fund at 5% of net asset value. The problem? Redemption requests hit 9.8%, nearly double the gate. Bloomberg reported that Partners Group shares cratered 16.6%, hitting a 52-week low. And the contagion spread instantly. KKR dropped 4.7% pre-market. Blackstone fell 3.9%. Carlyle slid 3.1%. REs lost 2.5%. This is what's called the redemption cascade, when liquidity stress in one fund forces the entire sector to reprice. CEO David Layton admitted the pressure that started in private credit is now spreading into other asset classes. And here's the detail that should concern everyday investors. These evergreen funds were designed for wealthy individuals and marketed as accessible alternatives. According to early reports that have yet to be fully verified, some private credit vehicles have seen redemption requests hit levels in the high teens as investors reassess their exposure to these less liquid assets. If you own financial sector ETFs or hold alternative investment funds in a brokerage account, this is your wake-up call. Private market stress doesn't stay private for long. 3 signals. 1 direction. Caution. Subscribe to stay ahead of it. This has been The Financial Brief.